makers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. Italian banks slide, dragging down the sector after the Meloni government plans a surprise tax on profits. Moody's lowers credit ratings for 10 regional U.S. banks and says it may downgrade major lenders. Plus, China's exports fall for a third straight month on slower global demand, while imports plunge in a new blow to the nation's economic recovery. So let's take a look at the European markets map. A lot going on. There's definitely a risk-off mood for two things. They worry about China. There's also a couple of things going on that I guess are short sellers that are worried about what's happening with Country Garden. So look out for stocks and bonds plunging. Country Garden in China. The other story is, of course, what's happening in Italy with the banks. So a couple of things going on. We also have the ECB. I don't know whether we have that figure yet, but consumers seeing inflation at 2.3% in 3 years versus 2.5%. So that's actually some pretty encouraging news from the ECB, certainly expectations from consumers. I don't know whether that then changes their behavior and whether that actually changes in how they spend, and so the trajectory of inflation. Euro dollar, you can see for the moment 109.77, but the big story is, of course, Italian banks. And the cabinet of Giorgia Meloni, the prime minister, approved a surprise tax on banks' extra profits this year to fund tax cuts, but also to support first-time mortgage borrowers. So let's look at what Italian banks are doing. You can see most of them really getting slammed. Intesa Sanpaolo down 6%, UniCredit down 5%. If you look at what these banks have been doing year to date, they're some of the best performers, certainly in Europe. And what's interesting about this package is that we understand by digging around that not a lot of cabinet ministers even knew about it, and it was slipped into a package of other measures, including the grant, for example, of additional taxi licenses. So it's definitely coming as a surprise, not only for people in Italy, but also really for the market as a whole, which is why we're seeing extra pressure across the board, a risk-off mood maybe led by that. So this is year-to-date performance for the Italian banks, and today they're getting slammed. Let's also have a look at the week that we've had so far, the picture, and I think it's really all about the 10-year yield because we're also getting a big issuance in the next couple of days. The U.S. 10-year 40140, and you can see in the last week the European stocks down 1.6%. So as we've been saying, Italy's cabinet had approved a surprise tax on the extra profits of banks this year. Now, the levy, which reportedly could bring in over 2 billion euros, was slipped into a package of other measures ranging from taxi licenses to foreign investments. Now, joining us now is Bloomberg's Tommaso Ebhardt and Stefania Bianchi to look at the U.S. banks as well. So, Tommaso, first of all, thank you both for joining us. Tommaso, I mean, a lot of people are saying, like, what is happening? We weren't really given a heads up. If you're a market participant, we understand that maybe not all cabinet ministers were 100% consulted on this. How much of a surprise is this tax on extra profit for Italian banks?
Francine, buongiorno. It came completely out of the blue. Last cabinet before the summer breaks, Rome is essentially empty, Milan too. Late evening, Salvini came out at the press conference discussing some new norms that were supposed to include more taxi licenses, a norm to protect Italian tech companies, also new rules for how to pay when you go to the beach this summer. And then in the middle of the press conference, Salvini say, oh, by the way, we are adding an extra a tax on the bank's extra profit. So this was announced late Monday. The decree itself doesn't exist, the text of the decree. So we don't know exactly what we are talking about. Analysts are estimating this could cost about 2 billion euros to Italian banks. The market has already lost 10 billion euros this morning.
Yeah, and Tommaso, I know you and I did an interview with the finance minister in Milan a couple of months ago, and we were talking about whether there was something in the cards, and at the time he says probably quite unlikely, or the market wasn't expecting it. So politically, is it because the prime minister feels she needs to give it to give in to Salvini, or politically what does it mean for also future decisions going forward?
Yeah, that's quite interesting. First of all, Giorgia Meloni didn't attend the press conference, didn't present this tax. We know that Meloni has tried for several months to reassure market that she's a pro-investor and her government is pro-investor. And then this came completely out of the blue. How I can read it a little bit is the sort of the more populist stance of the government. Salvini said that this is a way to give back money to taxpayers and to help people who are facing difficulties because of the cost of living and the higher mortgages. So the money will be used to finance aids for families.
So we have quite a lot of banking news going on, right? This is the biggest one with Italian banks. But Stefania, we also had Moody's actually concerned about several regional banks in the US. Is it new things that they're concerned about, or is it, again, regulation? Is it, the strength of the economy and things that we already know about that they were worried?
Well, Moody said this was part of a swooping look at mounting pressures on the industry. Obviously, earlier this year, we had the collapse of some regional banks, so this could be part of a follow-on to that. What they say is that they're concerned about higher funding costs and also potential regulatory capital weaknesses, and particularly rising risks for issues concerned with commercial real estate loans. So obviously, we all know there's less demand for office space, so there's less demand for perhaps these loans that are more risky, and all of these issues could erode potentially their profitability. So really, there could be more bad news for when the US markets open and for US banks. Let's see what happens to their shares.
Yeah, Stefania, we've also seen some changes at UBS. I mean, are we going to see more changes up until we have those earnings on August 31st? How big a news could we get by then?
So what we've seen a memo that includes about 40 appointments, some of them, about 6 of them from Credit Suisse for fairly senior roles, the global head of coverage and the global chief of staff, both of them coming from Credit Suisse. What we know is that UBS has already talked about downsizing Credit Suisse's, what they took on from the investment bank there. We're expecting to get more details when UBS come with their second quarter results. That's on August the 31st. So really, I think there will be a lot more details then. But already we're getting glimpses of what could happen there and what shape this bank from the bigger bank that UBS is going to create, what that will look like.
All right, thank you both, Stefania and Tommy. Stefania Bianchi in Dubai, Tommaso Ebhardt in Milan for joining us. A big day for banks. Now, joining us for a look at markets is JPMorgan Asset Management Head of Global Multi-Asset Strategy, John Bilton. Every time John comes on, there's a market event, and today it's the banks. I mean, the Italian banks are really kind of freaking out the markets because this was unexpected, it was unannounced, it was kind of put in a set of measures that, with taxi licenses. Yeah. Are you worried about what this means?
I mean, look, it's August. There's always bizarre announcements, markets are thin, and of course, you get these big reactions. I mean, is this a helpful move for Italy generally? Probably not, no. I mean, we'd be watching more what the BTP to Bund spread does from this. But the banks, let's look at them. This year, with Europe raising rates out of the trap of negative real interest rates, which really hurt bank profits, has certainly boosted the sector, but it's still a relatively cheap sector on a global basis. Is this a negative piece of news? Certainly. But does it really sort of remove the support we've seen for banks generally in the European context? We don't think so. I mean, it's worth noting this is a tax on profits. Roll back a few years, profit, yes. Exactly, and the banks had no profits. So this is a different story, really.
John, this leads me to my big number. So we've started doing this thing where we choose a big number every day. And today, of course, it had to be linked to Italian banks for John Bilton. It's 2 billion euros. That's a possible state revenue from the surprise Italian bank tax. Now, again, because it's taken everyone by surprise, we don't know whether it's 2 billion, 3 billion. So do you think it's quite, it's quite minimal, or do you worry? Are you invested in banks? I feel like they're getting a lot of political pressure, actually, on all sides, from either changing their model to give back because of higher interest rates, or they're coming once again in the firing line.
Well, as you know, we invest more at the country and regional level, but of course the financial sector is a major piece in so many regions. And one of the reasons for thinking structurally Europe looks like an interesting place to be, the banks are much cleaner. They're able to earn decent revenues, decent profits from the higher interest rate outlook. They've been stress tested to within an inch of their lives. And frankly, Europe actually has a very nicely balanced index. However, we've got a little bit of weakness coming through in data. German factory orders yesterday, pretty disappointing. The data from China today, again, showing that the global goods cycle isn't really getting going as we'd like to see. So we're having to pause a little bit on Europe just now and actually look elsewhere. Look to the US. You know, the large banks have done very well, obviously, and we've just seen a little bit of a shot across the bows to remember, you know what, inverted yield curves don't help those regional banks. So that story hasn't gone away, but the economy's doing all right, and so generally we feel comfortable to have some exposure to those markets.
John, does this impact actually the spread between Italian and German yields?
Well, I think what it does is it asks a question about the motivations of the Italian economic policy, and that, of course, is going to give investors some pause for thought when it comes to pricing Italian credit risk versus German credit risk. You know, it's going to be a few days to see how the market chooses to discount that, though.
John, thank you so much. And of course, also a reminder, in the last 10 minutes, we had consumer expectations for euro area inflation actually falling in June. They did remain above the ECB's target of 2%, but it's better news because they fell further in June. We'll be back with JPMorgan Asset Management's John Bilton. Now, coming up, signs of more stress in China's property sector as shares fall in another of the country's major developers. We'll bring you more details on that next, and this is Bloomberg. Welcome back, everyone. Stocks and bonds in Country Garden have plunged after Reuters reported the Chinese property developer said it missed payment on $2 bonds due August 6. Now, the company and its property management arm are now the most shorted members of the Hang Seng Index, following a string of debt defaults in China's property sector. So let's bring in Bloomberg's Rebecca Chung-Wilkins in Hong Kong. Rebecca, this feels to me like a huge deal, right? There's a lot of concern over Country Garden and what this means for investors if it defaults on some payments.
Yeah, absolutely. And that's really in part because Country Garden, when I first started reporting on 3 years ago, was an investment grade name, unlike many of its junk rated peers, at the time the second largest developer in China. And it still today is considered a proxy for contagion. Now, the issue that's really moving the assets this afternoon in Asian trading is this report from Reuters that Country Garden has said apparently that it's going to delay mispayment the date for 2 coupons originally due over this weekend, so effectively due Monday. Now, the prospectus for those 2 coupons shows a 30-day grace period. But if Country Garden does indeed have to start using these grace periods in order to make its bond coupon payments, it's certainly a worrisome sign for investors. And it comes off the back of other negative news. Country Garden, for example, had earlier also cancelled a share placement, had warned of a net loss in earnings in the first half of the year too.
But Rebecca, so how does this play into the wider pressures on property sector, right? It's difficult to know whether this is a property sector concern or whether this really spells trouble for the whole economy.
Well, there's 2 issues to that. The first is the extent to which we see a contagion effect if there are serious liquidity issues at Country Garden and if investors really start to consider default scenarios. So that is certainly a risk. Country Garden is still a very big player, once considered to be one of the survivors of the crackdown. It's about the 6th largest by sales in China. But more broadly, we have seen the PBOC, among others, making efforts to try and step in a little bit more quickly to try and ease the property sector. They did, for example, in quite a rare move, make a public announcement about a meeting they'd had with with private firms, including property developers. It named some of those developers, although they're not ones that really are watched for sort of distress scenarios. But you can see policymakers are keen to, at the very least, portray this message of support for the sector, which is so critical in getting growth up and running again in China.
Rebecca, thank you so much. Bloomberg's Rebecca Chung-Wilkins there in Hong Kong. Now, JPMorgan Asset Management Head of Global Multi-Asset Strategy, John Bilton, is still with us. John, it's unclear actually in this kind of environment where there's optimism, overall about the rally and what stocks are doing, but question marks about China, how you play China.
Yeah. I mean, China's interesting because it had an amazing first quarter in growth terms as it came out of the pandemic, but it faded really quickly. And I think there was a lot of hope of significant stimulus But you get the sense that policymakers in China are really walking a bit of a tightrope here. They don't want to use the blunt instrument of the property market and really create that speculative bubble once again. But at the same time, as your reporter mentioned, it's a very crucial sector to China, and it's very crucial both for investor confidence, but I think also consumer confidence within the country. And what we're seeing, and I think it came through the trade data, that lack of import growth, in fact, a much worse number than expected, negative 12.4%. You know, actually, it suggests that China is still really just barely limping along, I think, in terms of growth at the moment. So, you know, the property sector is a known issue, but it really does present policymakers with a question mark, which is stimulate and risk bubble formation or just really try and reassure markets.
So we have confirmation from, you know, Bloomberg sourcing and reporting that actually bondholders and country gardens the holders have yet to get coupons. If this were to be confirmed, how would you take the news?
Well, I mean, I can't speculate on an individual name, and we don't know the details of that. But I think what we'd look at is the property sector as a whole. What does it do? Is it pushes confidence out. I think investors at the moment are discounting Chinese stocks very significantly. If you look at China A, if you look at HSI, they're very cheap indices. Earnings, yes, have been beaten up on those. The earnings expectations have been beaten up on those indices. But at the moment, I think international investors are very reluctant to go back in. So this is actually probably a crucial acid test to see how policymakers choose to respond.
John, what's your overall take on stocks? Because I know, you know, Mark Klanovich has thoughts on actually that we're over optimistic about where stocks could be headed.
Well, I think, look, let's ask the question. I think the most notable feature of the recession of 2023 is going to be its failure to materialise. If that does indeed prove to be the case, then equities probably grind higher from here. We've had a decent earnings season. The fear that everybody has was that margins were going to get crushed because of higher input costs. In fact, this earnings season in the US has shown margins expanding. So we think that there's resilience. We think the pain trade is probably still drifting a little bit higher. No reason to go out and get overexcited on equities. There's plenty of other places to put money to work. But the idea that stocks are overvalued and due a sudden major correction, we think might be wide of the mark at the moment.
John, thank you so much. JPMorgan Asset Management's John Bilton stays with us. We'll talk earnings with him next. This is Bloomberg. This is a picture for Italian banks. Now, it is, or is meant to be, a quiet day in August, a Tuesday. Happy Tuesday, everyone. And then we have this surprise tax on Italian banks again. This is on profits. This was decided at a late-night cabinet meeting. We understand that maybe not all also cabinet ministers were attending that. So some of them themselves were taken by surprise. Now, what we understand, again, because it's a surprise by various calculating forces, is that the government could get in around 2 to 3 billion euros thanks to this tax by year end, and they would redistribute it either to help with first-time mortgage holders or also to support the ones that need it the most. Now, we have a wonderful equity research arm, and they've also just put out a story basically saying that this 2 billion euro Italian bank levy could shave 10% off net income. Now, this is what they've calculated so far, and this is by this proposed extraordinary tax on their extra profits this year. Again, everything's to play because we don't exactly have of the details yet, and we don't know also if these banks will push back and get anything. Now, SoftBank shares closing higher after the group's Vision Fund eked out its first profit in more than a year, driven by the global tech rebound that helped lift the value of some of its investments. Now, the Vision Fund swung to a profit of $426 million in the quarter to June, following a record $30 billion loss in the last fiscal year. Still with us is JPMorgan Asset Management's John Bilton. John, overall, when you look at earnings, and I know, we talked about the Italian banks a lot. We look at SoftBank, and it was much worse than expected. It feels like, I guess, 80% of earnings didn't do too badly, and the one that did worse and really got slammed in terms of share price. What's your take on the earnings season? Well,
I think, it wasn't a big surprise in terms of where the beats and misses came in some regards, particularly between top line and bottom line. There was quite a marked slowing at the top line. We've seen nominal growth come down. Inflation's starting to cool. It's what everybody wanted. So guess what? When nominal growth goes down, it's harder to earn those big bumper top-line profits. So it wasn't such a great season at the top line, and firms that missed at the top line really did struggle. But what we saw was actually surprisingly good beats at the earnings line. So actually profits holding up much better than I think some had feared. And so as a result, overall, the earnings season, certainly in the US, was reasonable and reasonably well spread. And I think that what we've seen is really the bottoming of that downgrade cycle that's been running now for getting on for 12 months. We've seen earnings per share expectations for this year coming down from just shy of $250 per share to a little bit below 220, and that feels like a much more reasonable level. So here on in, we think that the earnings expectations at least have probably bottomed.
All right, so thank you so much, John, for joining us today. John Bilton, the JPMorgan Asset Management Head of Global Multi-Asset Strategy, of course, on everything from Italian banks to some of the surprises in the Chinese economy, also looking at earnings. Now, coming up, the ECB says consumer inflation expectations fell further in June, but they remained above the central bank's 2% target. So we'll discuss that next. We'll have a full roundup also on what's happening in China with country garden shares and bonds sinking. As we understand, holders are yet to get some of the coupons. So Italian banks slide, dragging down the sector after the Moody government plans a surprise tax on profits. Moody's lowers credit ratings for 10 regional U.S. banks. It says it may downgrade major lenders, plus China's exports fall for a third straight month on slower global demand, while imports plunge in a new blow to the nation's economic recovery. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. So consumer expectations for euro area inflation fell in June. It remained above the ECB's 2% target. That's as officials ponder whether to continue their unprecedented bout of interest rate hikes. Now, joining us now is Bloomberg's David Powell and Justina Lee. So thank you so much for joining us. We have a market expert and we have, of course, our chief European economist as well. David, talk me through about what this actually means for the trajectory for inflation. So if consumers think they'll pay less, is there a feedback loop?
Well, exactly. If the expectations of consumers are lower for inflation, when they go to ask for their salary increases in the following year from their employers, they'll ask for less money. And basically, that's why the ECB is concerned about elevated inflation expectations. They're worried about a spiral whereby people expect higher inflation, and therefore they ask for more money from their employers, and then employers have to raise prices, which raises inflation. It just ends in a vicious cycle.
And just, what does that, I mean, when you look at inflation, this is moving everything, right? Every asset class, every kind of thought about what central banks can do. Is there a point where we think that inflation and even expectations are coming down, but then to get from 4% inflation to 2% is going to be the really painful bit?
Yeah, I think exactly that's what the ECB is struggling with right now. There normally is a bit of a lag effect from monetary tightening coming through. And so you have to think about whether you're eventually going to see those effects, and that's going to be enough to curb inflation. Now, the recent data, and including this survey, has shown that things are moving in the right direction. But at the same time, like you said, it's still above 2%. And also, if you look at market expectations of inflation, those have actually risen lately, which is certainly worrying as well.
Yeah. So, David, what are we getting in September? We're probably, are we going to get a 10th straight increase in the deposit rate, or could there be a pause? And how would the market interpret all of this?
Right. Well, our official call is we'll have one final hike of all the policy rates by 25 basis points. But we recognize that final hike is kind of on a knife edge. It may or may not happen. We still have one more inflation report before the ECB meets again, and that's going to be very important for members of the Governing Council, because as they look around at the economic data, they can see that the balance of risks is clearly shifting, that they do too much. There are several areas of weakness, and they don't want to go overboard. So we think it'll happen, but we realize that depending on what happens between now and then, given the data dependency of the ECB, there's an elevated chance it may not materialize in the end.
Yeah, and Christine Lagarde was really at pains in saying, guys, and it's going to stay longer or higher for longer. Is there a market expectations that then they go lower too quickly, or that will stay at these levels for quite some quarters?
Well, something that Lagarde's been trying to emphasize really since Sintra is there will not be any cuts in the near future. So what they want is for those higher interest rates to be priced out in the curve to have their full impact. So that's really what they're focused on now, communicating that message. Obviously, the market is not entirely bought into that in the euro area, particularly as it sees cracks in the economy, which are emerging more and more now.
Yeah, so what are you watching for? I mean, the market is kind of on tenterhooks, right again, but it's interesting that the communication language of the ECB is then being replicated in other central banks. What are you watching for as we get into September?
I mean, the big data point this week is the U.S. CPI, and there we're kind of looking at a similar trend where the data is going in the right direction, but maybe not kind of quickly enough. And of course, the Fed is kind of grappling with similar pressures. And I mean, increasingly, people are even kind of thinking about, are we going to get a soft landing, or are we going to get a recession after all?
And I don't know how, I mean, it's unclear, right, to see, depending on what Lagarde says in September, how asset classes move, because sometimes it's been counterintuitive and they've gone the other way.
Yeah, right. That's exactly right.
David, when you look at what we're seeing from the banks, and actually a lot of the Italian banks, does that put a pressure on financial stability? Does it widen the spread between Italian and Germany? I mean, is this a problem for the ECB?
I think if anything that is going to concern the ECB about what has happened is the whole point of monetary tightening is to reduce the amount of money in circulation and to lower stimulus. And basically what the Italian government has announced is they're taxing banks in order to fund tax cuts.
Yeah.
And so if you're trying to reduce the amount of monetary stimulus, but on the other hand, the government is pumping in more fiscal stimulus, to some extent it's undoing some of what the ECB does. And Lagarde and other members of the Governing Council have tried to emphasize that it is time for governments to rein in the fiscal stimulus, particularly the measures that were put in place to combat the energy crisis, because the more governments try to stimulate the economy, the more the ECB has to do to withdraw monetary stimulus.
Yeah, our head of equities actually in the newsroom, Blaise wrote it in saying, you know, if you look at how much it's wiped off Italian banks, it's actually 10 billion euros in value right now because of the new tax. And the new tax, we understand, could have brought in 2 billion euros. So to put that into context, the market price move is quite extraordinary today. Justina, on the Fed, so what did you make of the U.S. jobs report on Friday?
Yeah, I mean, you're kind of getting mixed signals here, right? I think
that's what the market is like. What?
Yeah, I think like sort of a good interpretation of it is like, you know, job creation is still slowing, and so maybe people are simply not posting as many job openings. That's certainly, you know, one interpretation of kind of how you might be able to get disinflation without a recession, maybe. But at the same time, I mean, wage growth is key here to inflation, and that's kind of remained pretty hot.
David, does the ECB, I mean, of course they never say it, but how much do they get influenced by what the Fed's doing?
Well, the ECB, of course, as you say, they're always going to say they're influenced or they're driven by what's going on in the euro. And of course, they are driven by what's not going on in the euro. But they can't ignore
But it's interlinked. Right?
Exactly. They can't ignore what's going on elsewhere. One of the reasons, of course, is because it has an impact on the exchange rate, the inflation differential. The interest rate differential. But of course, they also want to see what their colleagues are doing. The ECB is the second largest central bank in the world, so of course it's going to be looking at the the largest central bank in the world to see how it's combating conditions which are similar and when it's going to pause, etc. So yes, the ECB driven by what's happening in the area, but certainly not ignoring what the Fed is doing.
All right, thank you both for joining us. David Powell there from Bloomberg Economics and Justina Lee from the MLive team. Now, coming up, we'll have more on the fallout from the Italian Prime Minister Meloni's surprise new tax on Italian banks. More on that next, and this is Bloomberg. The conversations that matter, the insights you need. This is a Pulse. I'm Francine Lacqua here in London. Now, shares in some of Italy's biggest lenders firmly in the red after Prime Minister Giorgia Meloni unveiled a new tax on banks. Now, the move could have huge implications for the country's banks. We're now joined by Head of Financials of Federated Hermes Limited, Filippo Alloatti. Filippo, as always, thank you so much for joining us. Look, we're looking at the banks. They're slammed. In fact, I think this new tax swiped some $10 billion from market value of all Italian banks. Like, what's your take on this?
Yeah, it's a bit surprising, and I think that's not the first time, and neither won't be the last time. But yeah, the politician put the short terms, say, fiscal gain in order to, and potentially at the cost of longer term cost of equity for the banking sector. Yeah.
But so if you look at who will be taxed the most, is it unclear at the moment if there are certain banks that would do worse than others?
Yeah, based on essentially the available information, because it's not yet been published in the official gazette. So the most domestic banks, the one that rely mostly on the credit business, they will be impacted the most, like bank like BPER or BAMI or Intesa San Paolo, more than, say, UniCredit because of the international footprint, and Mediobanca because it's more into, say, wealth management and more than traditional banking. Yeah.
But so how much do we know? And again, because we're kind of all grappling out, is this extra profit that they would have done in Italy, booked in Italy, or worldwide?
I think also it's booked in Italy, and it's the extra profit essentially from 21 to 23. Essentially, it's how much the banks are gained from the ECB tightening policy.
Would this impact dividend policy?
Potentially, yes. I mean, so I think at the margin it impaired the share buybacks and potentially the dividend policy. Yeah.
So, Filippo, I mean, do banks have any ability to push back on this?
I don't think so, yeah. I mean, so in theory, they could say, okay, you know what, we're going to lend less to the real economy. This, I think, is a possibility. In order to, say, retain more earnings, they could say, yeah, we wanted to grow the book, I don't know, by 5-10 billion RWAs, but we're going to grow less because of this new tax.
So, Filippo, what does it tell us? I don't know how you're looking at it. Are you looking at it through the lens of a lot of European banks just being, politically slammed in other countries in Europe, and this is just symptomatic of that? Can we see other countries? Like, is this a game changer?
I don't know if it's a game changer, but and at least not in the short time, but more in the medium term. And I think government, they're sort of strapped for cash, and they want to finance either a fiscal stimulus or maybe pay for the cost of living crisis. Maybe they can resort to utilities or banks, especially traditional banks. I would think country maybe like Portugal, Greece, more peripheral country. Yeah.
The Italian government so far has put proposals through and then walked them back when there was either a market reaction or big pushback from Europe. If this is the case, could it be an entry level for actually investors?
Yeah, potentially. There is a big if. They say it's extraordinary. It's only applied to full year 23. But as you know, I mean, politicians, they don't like to take back at tax they introduce. So we'll see whether it's just one 2023 story or in 24 they come up with another similar tax.
So do you think that this could be a buying opportunity, or?
It depends on your outlook for the economy. I think if you think the economy will have, in Europe, will have only a swallow recession, then I think, potentially could be a good entry point, yeah.
So the entire sector is being hit today?
Yes.
Why?
Yeah, because, I mean, so people always react. So the first reaction is always in a straight line. They say, okay, today is Italy, what's going to be tomorrow? Maybe Germany, Greece, or Portugal, yeah?
If you look at the French banks, they've actually been the outstanding lot so far, also in terms of earnings and giving back to shareholders. Will they still stay on top?
Yeah, it's a possibility, but at the same time, I think we're nearing the peak in terms of net interest income. So probably Q3 or in some case Q4 also will be the peak of the cycle. Unless, of course, the ECB decide they want to do even more and go the extra miles.
So, Filippo, how do you break it down, actually, to tell, if you're an investor today and a lot of the European banks create a good value, but where do you go? Is it country by country, or is it segment by segment?
I think segment by segment. So you want to have a combination of banks that are universal and then banks that are not too exposed to, for example, single sector, like, for example, mortgages or commercial real estate. And then also you want to look at the organic capitalization of the banks. And these are across the jurisdiction, across the business model. And some banks that actually do have a good track record of accruing the book value and the capital generation.
I mean, it's very difficult if you're a European bank to compete with Wall Street.
It is, yeah.
And so what does that, again, what does that mean for future growth in business models?
Yeah, well, I mean, so it means that they need to be a bit more niche in some cases, because as we've seen with Barclays, Deutsche, Credit Suisse in the past, it doesn't really, you can't really compete against the money center in America. So be nimble, also grow maybe in Asia or in some part of the market when there is less presence from the American banks.
Yeah, what's your take on I mean, I talk about Swiss banks, but the Swiss bank right now.
Now there is one Swiss bank, and I think also the management will have, they will cut off, and I think, it's going to be 2 or 3 years when they will really look into the fabric of Credit Suisse, UBS.
I mean, do UK banks look relatively attractive compared to everything else?
I kind of think so, yes. I think actually our view is that UK is not that bad, all considered, and I think if we get some, say, subside in terms of this inflation panic and the BOE near its job, then I think also they could potentially, we could see a pop higher for the UK banks.
Filippo, overnight we also had news that Moody's, I think, downgraded some of the smaller to medium-sized US banks. The reasons they gave are things that you and I talk about on a weekly basis, but if they start touching the bigger banks, does it actually make a difference to your investment strategy?
The top 6, potentially. If they touch the top 6, yes, but I don't think so. I think in the medium term is very unlikely. I mean, those banks that touch, I mean, there's also all in all is a relatively mild ratings downgrade. It's nothing like 2 notches or 3 notches. I think essentially it goes back to the ALM mismatch, which is more pronounced in America than in Europe, and then the fact that deposit beta are much higher in America than in Europe. But as always, the rating agency, we may be past the peak in terms of deposit beta. So they act now, but probably they referred to 3 months ago.
All right, Filippo, thank you so much. Filippo Maria Alloatti, their head of financials at Federated Hermes Limited. Now, coming up, TSMC is expected to approve the construction of a factory in Germany. We'll bring you the details next, and this is Bloomberg.
I think the biggest opportunity is that Japan is steadily becoming a cashless society. While the adoption rate is still low compared to other countries, it means significant future growth is possible. I believe refining our service will lead to even greater revenues. The challenge, on the other hand, is concerns for security. During the pandemic, many people got comfortable with shopping on e-commerce sites. But when it comes to digital banking, we're hearing questions of security and safety from many of our customers. Our job is to resolve customers' concerns by carefully explaining the safety and reliability of our services. It's not an easy task, and it is a great challenge, but promises a great opportunity.
Speaking of opportunities, so what do you think of the BOJ's policies, in the future, especially the end of negative interest rate policy? Would you think that's going to help your business, push up your profits?
The majority of our assets have floating interest rates, probably the highest proportion among Japanese banks. What does this mean for us? Most of our interest rate income will increase in tandem with the rise in short-term interest. The decision is up to the Bank of Japan, but we believe the end of negative interest rates is a huge chance for us and would result in a significant increase in profits.
So what about tweaks to YCC? Does that impact your business or profits?
YCC についてはいわゆる長期金利が今後上がっていく。We believe the tweak to the yield curve control will have a positive impact on our revenues and profits. First, we can switch to a higher rate when a fixed rate asset reaches its maturity. Secondly, a fairly rapid pace of increase in our deposits means an incremental boost to our assets under management. That incremental part allows us to enjoy the positive impacts of rising long-term interest rates, maybe even more so than other banks.
The chief executive of Japanese lender, their Rakuten Bank, is speaking exclusively to Bloomberg. Now, the Tesla CFO, Zachary Kirkhorn, has stepped down after 13 years at the EV maker. This is a surprise shakeup that, of course, raises questions about succession in the top ranks of Elon Musk's company. Now, Kirkhorn will be continuing to serve in an unspecified capacity through the end of the year to, quote, support a seamless transition. And also, Bloomberg is told that TSMC's board is expected to sign off today on the construction of one factory in the German city of Dresden worth 10 billion euros. Bloomberg's Oliver Kirk now joins us with the very latest. So, Ollie, good morning. Take us through this potential deal.
Yeah, so $10 billion, or 10 billion euros, I should say, as you mentioned there, and about half of that is going to be in subsidies from the German government. So we've had a number of deals, but this is the largest proportion that the German government has put up for this, and this is all to create chips in order to service, you guessed it, the auto industry. And this is both to safeguard the future of this industry, where Germany is sort of in a difficult time now and thinking about where the catalysts of growth are going to come from. And so for them, this is really a sort of golden, medallion here. TSMC is seen as a sort of golden standard for the chip industry, and it's going to Dresden, where in Saxony, Silicon Saxony, where a third of all chips in Europe are being built. So it's important to have that sort of ecosystem there with a lot of partners. We understand this deal could also include partnerships with some local chip producers, including Infineon and some others.
So, Ollie, a huge push from the German government to own the chip sector. Is it actually going to work?
So this is the big question. Here's why it needs to work. So, just from the de-risking perspective, if there's anything that were to happen with China, to not have the supply of chips in the future is a huge threat to the old industry of Germany, the auto sector. But then the question is, since they're behind on EVs, where is the catalyst for growth going to come from? So they've put aside this 200 billion euros, and that is going to go for climate transition, but also for chips. And as you can see there on the screen, 1 billion has already gone to Infineon, up to 5 billion here for TSMC, and 10 billion has gone to Intel. The question is, and this is the question everywhere, will they have the labor to do it? The German workforce is losing 400,000 workers a year in terms of skilled labor every single year. They're up to 7 million people short in the skilled labor economy by 2035. And so the question is, are they going to be able to attract all that skilled labor? Remember, TSMC pushed back their production of chips in Arizona to 2025, saying we just don't have the labor.
Ollie, thanks so much. That's a great point. Oliver Crook there for us in Berlin. Now, let's also get back to our main top story, which is Italian banks today. The government has shocked markets with this unexpected tax on banks' windfall profits, really sending the country's leading lenders down in trading. You can see Intesa Sanpaolo down 7%, Unicredit down 6%. We understand that the administration in Italy is looking for a cheap way to finance help for families hit by the cost of living crisis, including tax cuts and support for mortgage for first-time owners. However, the move also requires approval by Parliament, so it could be changed. If you look at some of the similar measures in other countries in Europe, like Spain, that was definitely challenged. The Deputy Prime Minister, Matteo Salvini, announced this 40% levy on the extra profits of lenders for 2023 late last night. Up next, Bloomberg Surveillance Early Edition with Kriti Gupta in New York and Danny Berger in London, and this is Bloomberg.